everybody. And yes, we are back. It's been a very powerful day since morning with a lot of insights and interactions across different topics. And like I mentioned, we now have a session on financing ESG projects, focusing on the financial instruments and funding mechanisms for ESG initiatives. This will be followed by the CEE ESG Awards. However, coming back to the spotlight presentation that we have right now, it's going to focus on incorporating ESG factors into financial decision making, attracting sustainable investments and financing green initiatives, and assessing the long-term financial benefits of ESG integration. Let me now introduce our speaker for the spotlight presentation, Mr. Labanya Prakash Jena, Senior Manager and Head, Center of Sustainable Finance, India Climate Policy Initiative. Requesting you to turn your video on, please. While he
Yeah,
joins us, a few more words about him. Mr. Jena leads the Center for Sustainable Finance program and has a rich and diversified experience of over 18 years in financial services, non-profit institutions, technical assistance in international development, and academia. Before returning to CPI, he worked as Regional Climate Finance Advisor in the Indo-Pacific region at the Commonwealth Secretariat. In his earlier stint at CPI, he was working as a manager climate finance for over 5 years. He also worked as an energy finance consultant at World Resources Institute and GIZ. He has also worked as a sustainable finance consultant at UNDP, where he was leading in the development of India's sustainable finance roadmap in association with the Ministry of Finance, Government of India. Mr. Jena is an author and a regular columnist and speaker on climate and sustainable finance in various platforms, media events, and a visiting faculty at different business schools. He is a certified expert in ESG and impact investing from the Frankfurt School of Finance and Management. Mr. Jena, over to you to take this session forward. I will just give you the rights to share your screen so that you could share your presentation and get started.
thanks, Sital, and thanks for inviting me to speak in this forum. Let me share my presentation very quickly. Yeah. Okay, good afternoon, everyone. So it's nice to be here in the company of senior executives. So I will not spend much time on explaining ESG, but just to give a very broad perspective on the history of ESG. So initially, sustainability words has been there for a long time, but ESG is a recent phenomenon. I mean, although 2006 is not a recent phenomenon, when the Secretary General of United Nations they invited the executives both from financial institutions and corporates, particularly financial institutions, to integrate environment, social, and corporate governance in investment decision making. But over a period of time, ESG became very popular, particularly in the financial sector. In the policy and regulations, we have never noticed ESG as a concept. But in the recent years, we are hearing that even the financial regulators, including securities regulators and central banks, and they are very much concerned about ESG. Even they keep on discussing that how, for example, ESG rating is affecting the businesses and how we should regulate that. Even with the policy making notes also, we are noticing that ESG as a concept is also discussed. So it is no more restricted to the financial sector. It is also restricted in the non-financial corporations and also among the policymakers and regulators. So as we know that ESG is a broad concept, it's a combination of environment, social and governance aspect. When you say environmental, it's a combination of climate change, resource depletion, waste, pollution, deforestation, then there is social and governance. Social and governance has already been there for a long period of time in the corporate history. But climate change is a recent phenomenon because the impact of climate change and all the scientific research around climate change has been into the public domain in recent times, or I can say in recent years. It has never been a discussion point in the financial sector at all. So particularly after 2015, the Paris Agreement, when 192 countries They signed the agreement to limit the world's temperature by 1.5 degree. Since industrialization, then climate change became a buzzword in the corporate world and in the financial sector. But if we see the World Economic Forum Global Risk Perception, which the World Economic Forum has been doing for several years. So if we see that what are the key risks they have identified, so environmental risk is one of them, particularly both in 2 years. But if we see the 2 years, and most of the risk is related to climate change, starting from failure to mitigate climate change, failure to climate change adaptation, natural disaster or extreme weather events, because all these events are attributed to climate change also. So climate change is becoming a serious word in the financial sector. So when we discuss about climate change, basically it has two risks, two component. One is physical risk and another is transition risk. So physical risk is related to, it's again divided into two components, both chronic and acute risk. Chronic risk is a combination of increase in temperature, agriculture productivity decrease, and rising sea level, which happens very gradually, but it's a massive risk for the ecosystem, for the society and the economy. But acute risk is more of an event. It happens once in a while, but hits very hard to the economy and subsequently to the financial system. It is a combination of heat waves, which we have noticed in recent times in northern part of India, in entire India, but it's not restricted to only India. So we are noticing heat waves across the world, how it is affecting the agriculture production. And also cyclone. The increase and intensity of cyclone events has increased significantly in recent years. Similarly, wildfires, we have witnessed wildfire issues in Australia, and we are noticing wildfire issue in Canada also, and the fire, it also reached New York as well. Similarly, on the transition risk, because to mitigate climate change risk, so we are also noticing that the policies and regulations are also is coming, which is not in the favor of the sectors or the businesses which are carbon emitting in nature. So it is in the favor of businesses which are climate friendly in nature, which will help in reducing carbon emission. And there is also technology development, because the cost of carbon reducing technologies is declining significantly. For example, the cost of solar has decreased by 10 times in the last 10-12 years or so. So it means that the technology which are carbon emitting in nature, they are going to be outdated in the future. Similarly, the consumer preferences are also changing over a period of time. So consumers, both B2B and B2C, we are noticing that consumers are preferring to the products and services which are less carbon intensive. Okay, so basically when we are talking about climate change, so it is affecting, as I said earlier, both businesses and households through physical risk, for example, cyclones or sea level rise or floods, these kind of events. It damages properties, disrupt business operations, and it's a possibility that it can create stranded assets as well. On the other hand, it also this also results in loss of household income, because as we know that whenever there is a weather events, so it disrupt the household income as well, and it damages properties as well. So it means that it's creating a financial risk in the financial sector. So as we know that financial risk, it's creating credit risk, market risk, underwriting risk, operational risk, and liquidity. So credit risk, as you know that since the value of the properties get damaged, so we are also witnessing collateral depreciation. At the same time, the businesses, household businesses, their expected profitability are decreasing, and even the real profitability are also getting hurt. Similarly, since household income are also decreasing, so there is a possibility that they are likely to default whenever they take any loans for personal loan or housing loan also. Similarly, the financial market is also reacting as well, because the empirical studies show that the equity market and the fixed income market, they're also reacting to climate related events. It could be physical risk, it could be transition risk as well. But most importantly, the insurance companies, they are losing a massive amount of money due to with climate induced weather related events. There is a case study which suggests that 2 to 3 insurance companies, they are declaring bankrupt in every year in United States. One of the key reasons is increase and frequency of weather related events in the United States. But more importantly, the insurance premium is also increasing because the insurance company have started realizing that the intensity and frequency of weather related events are increasing. So they are increasing the insurance premium, and which results in large insurance gap. If it is a large insurance gap, which makes it extremely difficult for those assets to get financing from mainstream finance, or particularly commercial banks. And also it's disrupt the supply chain, and many factories also, it's no more possible for the companies to run the factory at a fully capacity utilization basis. Also liquidity, particularly some of the companies, they are finding it difficult to refinance their existing loans, because loans or existing bonds as well, because when the company issued bonds maybe a couple of years back, when climate change risk was not incorporated in lending and investment decision making. But now, once the lenders and investors started integrating climate change risk, so it increasing the cost of capital for the borrowers, which creates refinancing risk for the borrower. Okay, so coming back to ESG motivations, as I said earlier, so the reason why the financial sector is following ESG practices, there are multiple reasons. Definitely values and ethics, because even the financial sector, the players in the financial sector, including pension fund and insurance companies or mutual funds or commercial banks, they would like to develop, they would like to improve their PR rating. Although some of the companies, I mean, some of the entities, so they are aligning with the right values and ethics, but it's not entirely true. Many times, those institutions, they just want to improve their PR relationship. Second is risk management, which is very important, because ESG is a massive risk for banks and financial institutions, and both it create also tail risk as well. So they would like to minimize that risk. So that's another reason. And number three is a fiduciary duty, because it is the empirical studies shows that ESG is no more just a risk, it is becoming a material risk. If it is a material risk, it is important the banks and financial institutions must integrate ESG in their investment decision making or lending decision making and portfolio construction. The reason is that it is the fiduciary duty to protect the beneficiaries. That's another reason they are following ESG. And financial performance, of course, because ESG is expected to improve their financial, because it's also shown that ESG can help the company in reducing cost of capital. That's another reason why they are following ESG practices and systemic and economic sustainability as well. As I discussed, what are the key factors ESG growth into mainstream? ESG influence both investment risk and returns. And many clients also, they are demanding that the clients, the banks, the financial institutions, the investors who are raising capital from the financial market, they should be transparent. And the regulators also, financial regulators, both central bank and security regulators, they are forcing companies to disclose their financial concerning climate change and ESG. And it also allow the company to grow in ESG, because there is a massive opportunity available in the ESG space as well. Okay, so what are the products actually currently available through ESG? One is definitely green bonds because green bonds is a massive opportunity because if you see that amount of green bonds issued so far globally, it's close to I think 2.5 trillion or so. So green bond is one of the ways the corporates can use to raise capital from the financial market. Even if there are also history that whether green bonds are really helping the borrowers because the green premium is no more exist. But more importantly, for corporate perspective, it helps them to improve the PR public relations of the company. It offers them marketing benefits. And there is also a halo effect attached to green bonds because what happens that when you issue a green bonds, it increases the riskiness of that particular business, which help the business to raise cost of capital subsequently, and also else helps the business in attracting new customers as well. But from the perspective of the issuer, so there is no real difference between green bonds and conventional bonds. Because many times it also observed that after the primary issuance of any green bonds, the green bond premium is goes to negative territory. So investor must be very careful about that whether green bonds is helping them in reducing the riskiness of the portfolio. I mean, empirically, it has not been shown by any academicians. As I said earlier, the green premium is negative nowadays, 5 basis point to 2 basis points. The rating is also is very low also, and it is across the sectors and across the regions. It's not restricted to any particular sector or to any particular region as well. Here in India, so far 43 billion of green bonds has already been issued, mostly by renewable energy companies. Most of the green bonds are 5 to 10 years of denomination, and most of them are fixed maturities or so, and most of them are issued by the government entities like ERIDA, NHPC, NTPC kind of companies or so. But there is a new breed which is called sustainability linked bonds, which also help the companies which are not really purely green, which is a combination of green then other sustainability performance criteria. So sustainability linked bonds, its coupon is linked to certain key performance indicators. Key performance indicator could be carbon intensity, could be water usage, could be the percentage of women in the workforce. It could be anything. So which is also another instrument the corporate would like to use to raise capital from financial market, which is different from green bonds. It's not necessary that the companies must be in the business of green. Even the non-green businesses can also use this kind of financial instrument. But compared to green bonds, sustainable linked bonds has not been so popular in the financial market. If you see that the amount of capital raised in the sustainable linked bonds is only 76.4 billion dollar in the financial market compared to more than $2 trillion in the case of green bonds. And but more importantly, sustainable linked bonds is long term in nature compared to green bonds. It means that it allows corporates to do necessary adjustment in their business practices so that they can meet the necessary KPIs as mentioned in the bond prospectus. Then transition bonds, it is important that there are several companies which are in the business of, which are particularly in the hard to decarbonize industries like cement, steel, or shipping or airlines. So these industries are hard to decarbonize. So they find it extremely difficult to raise capital, reduce their carbon intensity. So this transition finance will help these kind of industries to raise capital, reduce, to invest in certain projects or certain technologies to reduce carbon intensity. So it is not, I mean, they are not allowed to issue green bonds, but still they can raise certain type of capital which will help them to reduce carbon pricing. Transition bonds is just a component of transition finance. Basically, it's not purely green bonds, as I said, used by any industries, including the industries in the hard to decarbonize sector. Uh, then the proceeds of the transition bonds, it's used to reduce the environmental impact, and it can be used exclusively for new projects as well as the new projects as well. Because what happens that in certain companies, they would like to change certain machinery or certain equipment, and they find it difficult to finance that equipment from commercial banks, because commercial banks, they rarely differentiate between a green loans or non-green loans. Even if they differentiate, since the industries in the hard to decarbonize industries, so they find it difficult to raise green bonds, so they can use transition bonds to raise capital. So this is the status of transition bonds. So far, only $3.5 billion have been issued, but the way the transition bonds is getting traction, even for a country like India, whose manufacturing is growing at an enormous speed, will witness that many companies in the manufacturing sector are going to use transition finance is one of the ways to raise long-term financing. These are some of the companies which have issued transition bonds. Okay, another key point I would like to highlight, because many times we are also witnessing that whether ESG is really creating value, because empirical research is not really saying that the ESG is offering or creating positive value. So the results suggest that it's neutral to negative, and there is little evidence actually available that good companies are able to grow faster than the bad companies. But more importantly, it is sure that the effect of ESG, mostly negative to positive, but mostly positive. If we see on the risk part, if any company is following ESG practices very well, it helps the company to minimize the risk. It's not more about increasing the revenue or so. It is more related to cost of capital of the company. It helps the company to reduce the tail risk. It means that the company can reduce the cost of equity and it can reduce the cost of debt, because banks or financial institutions, particularly long-term financial institutions, they are not looking at ESG as a value creation. They're looking at that it's a massive risk, it's going to hit them. So it helps the company to raise capital at a lower rate compared to those companies whose ESG practices are not so good compared to the peers. Uh, uh, Even if it suggests that the most of what we are noticing in the ESG space, most of the evidence are anecdotal in nature. There are not really empirically proven that ESG helps the company in increasing their valuation. So it's extremely difficult that to tell, okay, ESG really creates value. Secondly, is that there are some instances that company get benefit out of doing good, but many times it's just used as a marketing tactic. Uh, and even if some of the economists, some of the academicians, they have also suggested that we should drop social and governance part from ESG, because many times social and governance part, since it's subjective in nature and companies take it for granted, they camouflage many things, because what we are noticing in the financial market is that since the ESG rating methodology is not uniform among the rating agencies, it is creating a massive problems for investors to differentiate a good ESG company and bad ESG company. So even if the economist last year carried a long story that, okay, whether ESG is really creating any financial value, in real value to the society. So they also suggested that it's better to drop a social and governance aspect and focus on environmental aspect, because the environmental aspect is more or less quantitative in nature. Okay, I'll stop here. Thank you very much for being here. Thank you.
Thank you so much. If I could just take maybe another 5 minutes of yours, we have a few questions which I thought I could, ask you right here on this platform, Mr. Jena. So, a great presentation, a lot of detailing, and I think, of course, green bonds is something that has been quite popular across the infrastructure space per se, and now, like you mentioned, some other transition bonds as well, and other options too. If I were to ask you, what are the key challenges and opportunities that you have observed in sustainable finance, especially in context to India's climate policy and the power industry?
In the power industries, I mean, it's a it doesn't matter actually. It doesn't matter. See, in the power industries, mostly they are issuing green bonds in the secondary market, particularly refinancing their existing loans. So the risk is not really related to green or climate. The risk is related to the off-taker risk. But more importantly, uh, related to climate policy, definitely it's very critical because government of India has not really come out with a clear cut carbon pricing mechanism, since there is no real carbon pricing currently in the Indian economy. So it is not really helping many low carbon intensive companies to raise sustainable finance to grow their businesses. But we are also noticing very positive signal, positive regulation from central bank here in India. I mean, many of you probably know that RBI came out with a sustainability and climate change guideline last year. So it
Hmm.
means that the commercial banks are becoming really active in this space. It means that they are giving a signal that the corporates which are emitting in nature, their cost of borrowing will increase in the future, and so the corporate should be prepared enough. There are many challenges, including there is no taxonomy. That's one part. Second part is that the capacity among bank and finance institutions are not really up to the date to differentiate a business which is carbon intensive, compared to businesses which are less carbon intensive. Even the credit rating agencies, I'm not sure they are really integrating climate change risk or sustainability risk in rate loans or bonds. If they're not rating, so it doesn't give any incentives to the borrowers or the companies to raise sustainable finance.
Right, right. Also, we see that sustainable finance often involves a complex interplay of government policies, market dynamics, and investor preferences. So, how does India's regulatory environment influence sustainable finance decisions for the power industry?
Uh, Power industry, I mean, we have seen that, for example, if central bank tomorrow says that you must differentiate between a good company and bad company based on carbon intensity. The companies which are in the business of, let's say, thermal power generation compared to the companies which are in solar and wind, definitely carbon intensity will be much less compared to the business to the power companies which are carbon intensive in nature. Right now they are not differentiating, but once in kick in, so there is a possibility that the lender will price that carbon intensity. They will price that into the loan, so the cost of borrowing will be higher for carbon emitting power businesses, and it will be lower for lower carbon intensive power businesses. It's not happening now due to varieties of reasons, but it will kick in very soon. And another critical point I would like to incorporate, I would like to add here. State Bank of India recently came out with a request for proposal because they are going to announce or disclose the scope 3 emission. It means that they would like to show that what is the carbon emission of the lending portfolio, okay, which is a massive signal. It means that they in future they are going to differentiate between a business which are carbon intensive in nature and a business which are less carbon intensive in nature. So it means that there will be pricing and differences of loans coming out from SBI concerning the carbon risk.
That's actually a great way and a great introduction, I must say. In the Indian context, your suggestion here on how can organizations effectively communicate their ESG commitments and progress to attract sustainable finance and investments? What would your suggestion be?
The top 1000 company, there is already rules and regulations by BRSR. So if you are in the bracket of top to 1000 companies, So you must disclose all the data points required to the potential investors. The For companies, definitely they should follow the best practices, at least compared to their peers. They must reduce their carbon intensiveness. It's not necessary all the points that all the time that reducing carbon emission may be capital intensive in nature, but there are several technologies which help the company in improving their profitability. So practically, it is already proven that by following certain low carbon technology helps the company to improve their profitability and return on capital investment. So there may be challenges to raise capital and invest in low carbon technologies, but ultimately it helps the companies.
And how about for organizations that are new to sustainable finance? What steps do you recommend they take to navigate, the landscape and secure funding for their ESG initiatives?
Definitely, they can use the existing financial instrument, the new financial instrument like green bonds, sustainable linked bonds. They can use that, and most importantly, they must disclose actually, which is critical. They should because investors and financiers, they will be very suspicious even if you are not in the category of top 1000 companies. If you are not disclosing enough, so you will be in the eye. I mean, the investors will look at you very suspiciously. So it is important for this company to disclose as much as data points possible. So otherwise, if you are following good ESG practices, it only benefits you if you disclose. That helps the company to differentiate you compared to your peers, and hopefully it will help you to raise sustainable finance.
Thank you. Thank you for so patiently answering my questions. On a concluding note, any advice that you have for the businesses and investors, seeking to align their strategies with India's climate goals while achieving financial sustainability? We could, conclude the spotlight presentation with that, but any advice that you have in that front?
Okay, I'll say that okay, there is a massive investment opportunities because as we transition to a green economy, so that's definitely a massive investment opportunity. I mean, if you see the McKinsey report or Standard Chartered or UBS, they will say, okay, trillions of dollars of investment opportunity in the next many decades. I can understand that all the low carbon technologies are not profitable in nature, are not really profitable right now. It will not be profitable for the next many years. But we must mention that if you enter into the industries at a early stage, it will help you, it will benefit you immensely in the future because it's not, I mean, there is no carbon pricing right now, but when the carbon pricing kicks in, so if you are not ready to face the carbon pricing challenges, and you will be you'll be under tremendous pressure actually, both from the regulators, from the customers, and as well as from your investors. So you must be ready enough right now to reduce your carbon emission. Because once it kicks in, it will be in severe pressure. For example, European Union, they're coming out with cross-border carbon adjustment mechanism. And the steel industries are in really concerned about that because it may constitute 25% of their cost of operation, which is massive. So, for example, there is no carbon pricing in here in India, and IMF suggests that India's carbon pricing could touch $25 per ton. So if you just multiply the amount of carbon you are emitting with $25, you can understand that how much profitability are going to be eroded if you stay in the business, which is carbon emitting in nature. Even if you are carbon emitting in nature, if you are not making serious steps, serious efforts in to reduce carbon emission.
Sure, sure. We have a comment in the Q&A box. I'll just read it out in case you want to add something to this. So, one of our attendees says that it's very good from sustenance and environment point. We are going towards renewable power, but its PLF is but if the PLF is bad and environment dependent, so thermal power is the base and 100 backup climate proof. We must not concentrate on improving the tech practices to improve performance.
No, he's absolutely right in the case that, okay, we cannot transition our energy system 100% very quickly. One is that it is not economic, technically it's very challenging. And secondly, it's not economically feasible also. to transition our energy system 100%. That's not possible. I mean, I completely agree with them, but we cannot say that we will stay we continuously rely on coal or oil and gas forever. At some point of time, definitely we need that as a base load. But at some point of time, when the cost of energy storage reduces significantly, again, I'm repeating significantly, definitely we can transition to completely clean energy. Although not completely clean energy, maybe 80 to 90% of energy we can source from clean part, and by using the low cost energy storage system like green hydrogen or battery or so, and the rest of the energy can come from coal or oil and gas, but we can use like capture storage system, which will help us still using coal and oil and gas. But at this point of time, he's right that we cannot rely on renewable energy.
Sure. Thank you. Thank you so much, Mr. Jena, for the presentation, for further sharing your perspectives with us. It was great having you join us, and thank you so much. Thank you. Have a
Thank you,
great
Tal.
day.
Thank you. Thank you. Bye.
So, ladies and gentlemen, with that, we come to the end of our conference. And